perfect ingredients for gold's next move. The U.S. Federal Reserve and central banks around the world appear to have the printing presses going full tilt these days. This has fueled the greatest V recovery any buy-the-dip investor could have asked for. Tech stocks and precious metal stocks alike have been among the best performers and outperformers year to date, and we'll get to the attention they're attracting in a minute. Fueling the fire even more are lower for longer interest rates and the yield curve control. Here is a chart that you're looking at right now, which shows the expectations for future interest rates. Each dot represents the expectation of future interest rates for each Federal Reserve Open Market Committee member. You will see that no member expects to move away from ultra-low rates until at least 2023. What does the Fed Dotplot mean? To me, it means that the Fed officials know the economy is not functioning properly, and it won't for a long time. It signals that the Federal Reserve believes the banking climate must remain ultra supportive for businesses to remain open and solvent. This has led to an enormous disconnect between the stock market and the economy. Historically, the stock market was a useful barometer of economic health. That's hard to argue today. To start the year, U.S. unemployment was approximately 3.5%, an all-time low. Last month, U.S. unemployment was over 13%. It is hard to see a picture of economic growth and stability like we saw in January this year. So why are stock markets within shouting distance of highs? The answer lies in ultra-cheap credit and enormous financial banking of the U.S. Federal Reserve. Remember, lower for longer interest rates? Except a lot of this capital is not going from Wall Street to Main Street to the average American citizen. Perhaps this next piece of information will spark your curiosity, as it did mine. U.S. bankruptcies hit 11-year highs. Through the first 6 months of the year, bankruptcy filings in the United States have hit levels not seen since the peak of the financial crisis. They have already surpassed the peak from the dot-com tech bubble. The chart you're looking at right now shows the reported public and private bankruptcy filings in the United States. While unemployment is worrisome, bankruptcies and insolvencies are much worse. And this is why the Federal Reserve is now buying corporate bonds. If companies fail, who is going to rehire all of the unemployed workers? Where is the government tax revenue going to come from? This is a very scary and, most importantly, a slippery slope to navigate. The next domino that falls in this situation is the velocity of capital. As bankruptcies increase, the velocity of capital slows down. The velocity of money is the number of times $1 is spent to buy domestically produced goods and services per unit of time. The higher the ratio, the more turnover of dollars there are. This velocity of capital is measurable through the velocity of money indicator. This chart that you're looking at right now shows the rapid decline in the velocity of the United States M2 money supply. With all of Donald Trump's Buy America focus, this should have increased the velocity of capital. But just the opposite happened. And coronavirus puts a nail in the coffin. At the same time, public debt held by federal, state, and municipal governments and banks is also at all-time highs. Looking right now is the U.S. Treasury total public debt outstanding. You can see now it's over $25 trillion. Pushing against the string will only work for so long before the chickens come home to roost. So how do you protect your portfolio? I've long said that the person who wins in a deflation is the one who loses the least. That's why I'm positioned strongly in precious metal stocks and US dollars. I think most viewing this get the gold exposure, but the US dollar exposure confuses and even angers a lot of people. As bad as you think the situation is in the US, the rest of the world is in an even worse situation. And when a liquidity crisis happens, the US dollar is the safe haven that benefits for now. But when the insolvency crisis hits, the US dollar will benefit even more. This year, gold is the second best performing asset class. First is the United States 30-year bonds. I bet you didn't expect that. These are the big winners this year for a good reason. Slowing of capital movements, high unemployment, and low productivity all point towards stagflation after the deflation settles. This drives demand for safe haven assets like gold and government bonds. The chart you're looking at right now is the year-to-date returns of most of the major asset classes in the US. Let's talk gold. Today, we have a plethora of stimulus packages and low interest rates globally. In addition, global politics are on a knife's edge. Not to mention, we are combating a virus that has killed almost 500,000 people around the world, which we still haven't figured out a vaccine for. This is a highly favorable environment for gold and gold stocks. In this chart that you're looking at now, you see that the gold has consolidated well in this upper range and has broken above its short-term resistance line. The yellow line is the support from the 1660 to 1680 range. This week, gold tested the waters above 1750. I do believe more consolidation around this price level will happen. The next level of resistance for gold is about $1,800 per ounce. If gold can clear 1,800 with the momentum and volume, the highs of 1,900 could be reclaimed very quickly. And that is when the fun actually starts for the gold market. New highs attract speculators and momentum. All the gurus that complain about algorithms and day traders will suddenly welcome them all with open arms. The reason? They bring much needed liquidity and speculation into the gold sector, neither of which the gold sector has truly seen in a decade. So, can you day trade gold stocks? Small players can day trade with ease. Of course, if you know what you are looking for and can interpret drill results or economic studies faster than others. But the big trading outfits need millions of dollars worth of volumes in names they trade in, not to mention a liquid derivatives market. Most of the junior resource stocks don't do that kind of volume in a month, let alone in a day. If gold breaks out above $1,800 per ounce, we will see a massive influx of new retail speculators entering the space. Speculation is an integral part of the natural resource sector. That's why you need to be ahead of the herd. Picking up pennies in front of a steamroller works for a while, but positioning yourself in world-class operators before the speculators and other market gurus pile in is how you make needle-moving, wealth-changing investments. A few years ago, my subscribers and I made a fortune in a gold company called Northern Dynasty. My due diligence told me this was a stock that was poised to scream higher. It did. Retail investors, also known as the herd, drove prices from 45 cents to over $4 per share. At the same time, the Northern Dynasty warrants, which think of them as a call option, were trading at over $4 a share price at that time. This was pure retail speculation, and it can spike share prices like a hockey stick, hundreds, even thousands of percent gains in a very short amount of time. You've seen in the US markets the past few months like Hertz and Chesapeake Energy and others making plus 100% gains look like small potatoes. The good news is this gold bull market is still in the early innings. Right now, I'm making big moves and putting millions of dollars into the market in precious metal stocks and into other hated, unloved, and undervalued sectors. The main focus is positioning myself and my subscribers at the same price as myself into companies with management teams that have skin in the game and at the same price as ourselves. Everyone has to be on the same platform. The cost base of the management team is the same as our own. With gold projects that deliver strong financial returns at $1,500 per ounce gold and have exceptional leverage to rising gold prices. If you found this interesting, please visit my website at Katusa Research and read my Market Millionaire. It's a free ebook to explain how to start speculating in the gold market.